some of the topics are there in one PPT, some of them are in another PPT. So basically, I will be shifting from one PPT to another PPT so that quickly we can do that. So what is risk? While doing APM risk and uncertainty also, we have discussed that one. Nevertheless, once again, we will talk about what is risk. It says risk is risk in business is the chance that future events or um, results may not be as expected. In the way it is presented, it basically talks about any kind of a variation from what is expected can be referred to as risk or uncertainty. Whether it is risk or uncertainty, it talks about having a variation from what is expected. Future is always planned ahead in an organization in order to achieve the organizational objective. So there would be planning taking place. So strategic planning would be there in place. So at that time, what what would be the expected events of the future will be anticipated. Accordingly, strategic plans also will be prepared, and later on they are narrowed down to budgets, and then implementation of budget, the rest of it follows. So at the time of planning, uh, what they anticipate for the future to happen, in the future to happen, if at the time of planning itself there is a possibility to know that there can be a variation. Let's say for the future, if there is an anticipation um, that the activity level at which they would be operating, let's assume that it is 70% activity level at which they would be operating, but they also see that there is a possibility of increase in demand, so they may operate it at 75%. So there are indication, there are chances that they could be operating at 75%, or some reason maybe they may not even touch 70%, or some 68%, 65%, something like that. So when these are all variations, otherwise the anticipated activity level was at 70%. So at the time of planning or little later, if at all, if they see that there is some amount of variation, um, there is a probability or likeliness that the activity level would not be, or the um, number of units that they would produce and sell, or any kind of activity which they are anticipating to for the future to happen, if there is a variation, if there is a chance that it would not be as expected, that situation is called as risk or uncertainty. See, whenever variation is also anticipated along with the expected values, the probability or the likeliness of such a variation also, if it is known, then we call that to be as risk. The likeliness or the probability of a variation to happen, if it can be known, the likeliness into the variation multiplied will be risk. We'll see the numerical part of it also, how risk is calculated. See, if the likeliness or the probability of a variation is known, it is risk. If it is not known, it is called as uncertainty. Uncertainty could be even sometimes the to what extent the variation would be also, if it is not known. See, what would be the variation, what is the probability of the variation, all these things, if they are not possible to be known, then we call such a situation as uncertainty. We are only talking about variation, we are referring to a variation, and that variation is referred to as risk or uncertainty. Variation sometimes could be positive also, could be favorable also. Therefore, risk need not be looked at as always a negative thing. It could also be a positive thing. So risk could be downside, or risk could be upside. See, if their anticipated activity level is 70 and they end up, or they also see that of possibility of operating at 75%, see, that's a risk, that's a variation, but that's upside, that's favorable. The level of activity increases, revenue increases, profit increases. It's only thing that they initially anticipated that they would operate at 70% capacity level. Now they end up operating at 75% capacity level. So when there is an increase in activity, profit also definitely increases. So the variation part of it only is referred to as risk. But this variation could also be sometimes favorable, sometimes positive. So then we call that to be as upside risk. Otherwise, it's called as downside risk. If it is unfavorable, if it is bad. Then there are definitions given by different accounting bodies about what is risk. There's one definition by CIMA official terminology is a condition in which there exists a quantifiable dispersion. Dispersion is variation, how farly the variables are scattered or they are dispersed. They are plotted away from the average value, that is dispersion. Quantifiable dispersion in the possible outcomes from any activity. Uh, that's the explanation given by CIMA official terminology. ISO guide 73 says risk can be defined as a combination of probability of an event and its consequences. So how do we explain that? See, um, See, the variation is the result of the happening of an event. So, we see that risk is also explained in this particular manner. That see, there are certain events which are expected to happen, events like change in demand, government regulation, that is like change in tax rate, etc. Customers' tastes and preferences, because of which the demand changes. The availability of resources like raw material, power, etc. See the pressure from various associations like environmentalist groups, etc. Multiple events which we can talk about. Employees' ability to meet the targets, whatever is expected demand, to meet the expected demand, their ability internally, their seriousness towards the work. Multiple events can be listed out, which can happen in the future. See, the event itself may not cause a risk, but there could be because of the event, there is a consequence. Consequence is quantified and measured in terms of money. So the consequences are to be calculated, that is quantified. So the consequences on account of the happening of an event. So consequences are expressed in terms of monetary values, monetary loss. Basically, we quantify that and talk about it as what's the monetary loss or monetary quantified value of the consequence. After the consequences are calculated, we also have to consider what is the probability of such an event happening of such an event. The probability also should be taken. So the quantified value and the probability, when both of them are multiplied, the monetary loss into the probability of happening of these events, okay, when both of them are taken into consideration, the sum total of all such things is calculated as risk. So it can be defined as a combination of probability of an event and its consequence. Consequences are a result of happening of events. Events could be anything. Maybe they could not produce the products because employees are not equipped, they do not have the required resources, capital may not be available, material may not be available, the time which is needed on machines is not available, labor are not available, multiple things. Then government suddenly comes up with certain regulations, certain norms and restrictions, so they cannot take up the production freely. Likewise, we can identify multiple events that can happen and affect the business. So list out all the events, and for each event what is the consequence of those events have to be quantified and recorded in terms of monetary value. then the probabilities of each of the probability of happening of each of the events also has to be considered, multiply them, and then find out what is risk. That's one way of defining what is risk. Basically we talk about variation. Because of these events are causing variations. Ultimately we come down to the same point, but each accounting body has defined risk in their own pattern. Then risk in business is the chance that future events or results may not be as expected. So after that, we need to look into the different types of risk. We will be looking into what are the different types of risk. But before that, what the question about why should risk be incurred? Why should risk be incurred? Because there is a relationship between risk and return. If risk is high, returns are also high. If risk is low, returns are also low. See, a best example we can talk about is there is an optimist investor, there is a pessimist investor. We also find these kind of these types of investors even in a family. Also, we can see some of them um, preferring certain investment opportunities and the others preferring certain other type of investment opportunity. Generally, the elderly people choose investment opportunities where risk is low, like going for saving in bank accounts, FDs, very conventional post office, national savings certificates, etc. It's very, very, very conventional. The only point what they would be considering is that there would be no risk in terms of losing their investment amount. So that's the main attracting point for them. So they see that if at all if something happens, they may lose their investment amount. So looking at the worst scenario or pessimistic attitude or an attitude of not taking up risk or risk aversion or something like that, so they choose investment opportunities which are um, very conventional, um, risk free or low risk investment opportunities. Some of them who are very optimistic, then they choose investment opportunities like investing in share market, real estate, foreign currencies, gold, silver, precious metals, etc. So we see that type of investors also going ahead and investing in different investment opportunities. For them, the attractive point is high return. Okay, so each of them have their own opinion, but along with these things we see the other aspect, the other side of the investment opportunity also can be seen. So if at all if they look at the risk to be low, see like bank account, savings account, post office accounts, etc. See the risk is really quite low, but at the same time we also see that the rate of interest that is paid on these investment opportunities are also very low. So we see that the return is also very low. If the risk is low, the return is low. Now, those with an optimistic view and opinion, if they are choosing an investment opportunity with very high returns like stock markets, real estates, etc., so the returns are quite high, but yet at the same time, if if they are hit on a negative term, so the risk also is quite high. If they are if they get affected by a negative trend in the stock market, the loss which they have to bear also is at that high note. Okay, so there is a relationship, there is a direct relationship between risk and return. If risk is low, returns are also low. If risk is high, returns are also high. So the question about why incur risk, One part of the answer is, if risk is taken up, if risk is high, the returns are also high. So to maximize the returns of profitability, one takes up risk. So increased financial return is one thing. Another important thing is to have a competitive advantage. To gain competitive advantage. If they venture into areas where no one has earlier done, if they take up decisions which involve risk, see, with the risk, the return also is associated. So we can see that the firm will be able to gain that competitive advantage, will be better off than others in the market. So the why incur risk? The answers are very clear: to gain competitive advantage and to increase the financial return. So those are the reasons why risk has to be incurred. Now we will be looking into different types of risk. So conceptually, each one of them has to be learned very clearly. Um, we will run through all these types of risks very clearly, and then of course it's very easy for you also to remember. There is nothing difficult and complicated, but term by term, what does each type of risk mean, what does each term means, and what risks are covered under that particular category, we will run through that and we'll remember that one. Okay. The first one, under the category of political, legal, and regulatory. See, on account of any, first one we see political, second it's legal or litigation risk, regulatory risk, compliance risk. See, political risk, because of political instability in an economy, there is a risk which arises. It's called as political risk. So it is due to political instability, generally considered to be external to the business. There are internal factors, there are external factors. So political factors are external. Of course they are not internal, but because of the political instability, the external environment gets affected, and the firm being part of that external environment also will have to bear that instability, the consequences of the instability, political instability. Okay, so that's the first type. Legal or litigation risk, risk that legal action will be brought against the business. So some legal action would be taken. Is there any kind of disturbance from my end?
No, ma'am.
Songs or something?
Yeah, song. Yeah.
I know. Independence Day, Josh. I don't know how long, where is going. Maybe it is a vehicle which is moving. Let's just wait for 1 2 minutes. I'm
Yeah,
not sure from where it is coming.
yeah, it's fine.
Vehicle which is, so it has passed. So legal or litigation risk, the second one. Risk that some legal action will be taken against the business. So that is legal or litigation risk. Maybe they have not complied with something, or they have not followed the norms, or so if there is a chance that some legal action will be brought against a business, it's called as legal or litigation risk. If there is a change in the regulation, until then something is there and now suddenly there is a change brought about, maybe there is a change in the amount of minimum wages which have to be paid to the workers, or there is a change in the tax rate which would be applicable. So because of some regulatory changes which are brought about, if there is any risk faced by the business, we call it as regulatory risk. Compliance risk talks about because of non-compliance, not complying with the regulations, the rules that are laid um, for the organization. Because of non-compliance, they would attract some penalties and fines. So that is compliance risk. So in terms of environmental issues, they have to follow certain things so that the impact of pollution can be minimized. Certain things which are laid down for a particular organization, if they follow, fine. Otherwise, if they do not follow those things, if they do not comply with those things, they can be levied with penalties and fines. So that risk is called as compliance risk. That's the first category: political, legal, and regulatory. Then business risk, the risk that affects a business. No, anything which can affect the business. We have different categories under business risk. The first one is strategic risk. Strategic risk is strategic level is always the top level in an organization. So there is planning that takes place at the organizational level. So the strategic level plans for the organization multiple things about what would be their activities, how would they grow, um, what measures would they take for expansion, growth, diversification? Otherwise, where would they be selling their products, domestic, international, global? See, these are all plans that take place at the strategic level. The chance that such strategies fail, if there is a chance, we call that risk to be a strategic risk that the business strategies will fail. So any plan that takes place at the strategic level, which involves the entire organization. So if these plans are not appropriate, if these plans fail, then the risk that arises is called as strategic risk. Okay, risk that business strategies fail, like acquisitions, product launches, etc. Next one, product risk. The chance that the product uh, doesn't do well or it fails. So risk of failure of new product launches. We see loss of interest in existing products. So they may not do well. At the time of launching the product, it could fail. The customers do not accept the product, or the one which is going on well, suddenly some information is passed on, and then suddenly we see there is a decline in the demand of that particular product. So loss of interest in existing products also may happen. Maybe sometimes some false information is spread, or competitors come with different features to their products, or differentiation. They may launch their products um, wherein the existing player may not catch up with those things, and their existing product may fail. The customers may lose interest in their product. So if at all, if the product is not doing well, if there is any risk associated with that, we call that to be as product risk. Commodity price risk, because of in the commodities market, if there is price fluctuation on account of that, if there is any risk which arises, we call that as commodity price risk. Product reputation risk, the reputation gets affected. Sometime back, that was the situation with Maggie. I don't know, um, some lab wherein this product was tested had come out with a report that the lead content in Maggie was above bearable limit. So suddenly the reputation, so now people started looking at Maggie as very dangerous for the health of children, kids, and then drastically uh, the reputation got affected. It was almost on the verge of exiting from the market. Somehow they renewed the scenario and they bounced back. So that was the situation. So sometimes we see for certain products, there's the image of the product gets affected. It could be based on some assumptions, some rumors, some false reports or news that come into the market, that is spread out, and then the reputation gets affected. Product reputation risk, operational risk. See, strategic level is at the planning level. Operational is, it is about implementation. See, risk that business operations may be ineffective. Um, at the time of implementation, at the operational level, if there is a failure, they may not be implementing it effectively, and therefore if there is any kind of loss that happens, risk that business operations may be inefficient, or business processes may fail, they may not be able to implement as planned. So therefore any kind of a loss that happens or risk that arises, we refer that to as operational risk. Contractual inadequacy. So at the time of designing or framing the contract itself, the terms of contract do not fully cover a business against all potential outcomes. So if at all, if the contract doesn't cover all the aspects, or it is not fully covering all the aspects of the contract, then any loss arises, it's called as contractual inadequacy. Fraud or employee malfeasance, because employees are involved in fraudulent behavior. Later on also, we will be, as part of the syllabus, we will be studying in detail about fraudulent behavior, fraud triangle, etc. So those things also we will be looking into. So because the employees are not ethically sound, they are involved in some fraudulent behavior, unacceptable behavior, what is, what ought to be done if they are not doing, and then on account of that, if there is any kind of a loss which the business faces, we call that to be as fraud or employee malfeasance. Okay, so that is about the business risk. What possible losses can happen to a business, or it is prone to different categories of risk, we call all of them together, we call them as business risk. Then we see the next category is what is economic risk and what is financial risk. Economic risk, it says this is the risk that changes in the economy, at the economy level. Economy might affect the business. These changes could be because of inflation. Certain examples are mentioned here. Inflation, unemployment rates, international trade relations. So everybody in the economy, they get affected because of that. It is not just subject to one industry, one type of business or a firm in the industry. No, it because it is at the economic level, the entire economy gets affected. So inflation rate, fluctuations in the interest rates, international trade relations, unemployment aspects. See what is the role of government in that, whether they take up some measures to resolve this unemployment problem, any fiscal policy decisions by government as to how much would they be spending, what is their expenditure to revive the scenario, etc. So all those aspects which affect everybody in the economy, we call that to be as economic risk. Again, this risk is considered to be external to the business. We have an analysis, APM we've learned about, um, which is PEST. All of them are external. See, the first category of risk which we have studied were related to political scenario, political legal. So PEST, political and legal together. Economic, second one. Economic is also external. So this is an external analysis, the external factors which affect the business. So these things have to be considered before a strategy is decided. So on that note, E falls under the category of external factors, so economic factors. Then the next type of risk is financial risk. So the risk that is the risk of a change in financial conditions. So financial aspects are taken into consideration because of a change in financial condition, such as an exchange rate, interest rate, credit rate of a customer, or price of a good. Okay. So this is a financial aspect, financial risk or variation in the financial condition or change in the financial condition. Any risk that arises, we call that to be as financial risk. Under financial risk, we have different types of financial risk. Okay. The first one is credit risk, because credit is a policy of the business to extend credit period to the customer. Within that credit period or at the end of the credit period, the customer is supposed to pay that amount to the business. Okay. If they do not pay, we call that as bad debts. So that's a risk. The possibility or the risk of non-payment by the customers. Now, this arises because of a decision taken by the business to extend credit period to the customers. So at the end of the credit period, they are supposed to pay, but see, the decision is always why would they sell it on credit basis is true. It's a strategy is to increase their sale, but along with this benefit of increased sales comes the increased risk of some of the customers not paying. So if it is bound by a legal condition or legal contract or agreement is there, they can protect their or the receivables amount, they can collect all the receivables amounts, but otherwise there is always a risk of bad debts happening, right? That's called as credit risk. Then next one is political risk. We've already studied once under the category of political legal risk. See here, political risk arising from actions taken by a government that affect the financial aspect. See, not in general, all of them, but very specifically, if that risk is quantifiable in a monetary value because of the changes in the political scenario, political, legal, generally they are combined together. Any, see, political, very specifically, precisely, if we look into that, political risk is about the instability in the political condition of an economy. That is political. But usually, along with political, the legal aspect is also the regulations which are laid out by the political parties or the ruling government. See, those things are also generally clubbed with the L part of it is also clubbed with legal part. So any kind of a regulation, changes in regulation, if it can affect in a monetary manner, we call that to be as a political risk. Risk arising from actions taken by a government that affect financial aspects of the business. Third one is currency risk. Currency risk, or we also call it as foreign exchange risk, foreign currency risk, because of fluctuations in foreign currency. So those businesses um, that have international transactions, international trade happening, because of fluctuation of foreign currencies, they when they get affected and if they face a risk, we call that to be as currency risk. Next one is because of fluctuation in interest rates. See, fluctuations in interest rate, usually any agreement involving interest rates would be fixed in nature. See, generally, of course, there would be agreements which into which parties enter into, considering the fluctuations in the interest rates. So we call that to be as floating rate, but otherwise, most of the time it is at a fixed rate, at the prevailing rate at the point of time when they enter into an agreement. Considering that, they enter into an agreement. If the interest rate increases, one party gets affected. If it decreases, another party gets affected. So, which means that here we see that someone or the other gets affected adversely. So because of fluctuations of interest rates, if the interest rate rises, somebody who gets negatively affected, we can call that to be as interest rate risk, or because of fluctuations in interest rate, if there is some risk that arises, it is beneficial for somebody, at the same time it is not beneficial for the other party. So when there are variations arising on account of fluctuation in interest rate, we call that to be as interest rate risk. Gearing usually talks about the proportion of debt capital that is employed in the total business. So that is gearing aspect of it. See, risk in the way a business is financed, that is both debt and equity. Okay. So it says that sometimes this is considered part of interest rate risk. See, the proportion of debt and equity. When we talk about see, broadly, if we talk about the points of differences between debt and equity, see, the first attribute of it is the cost aspect of it. The next part of it we can talk about it as risk aspect. See, in case of cost on the debt capital, the cost is lower than the equity capital. So cost aspect, it would be low in case of debt, but it is high in case of equity. The risk is high in case of debt capital. Why is the risk high in case of debt capital? See, debt comes with certain obligations. So when investors invest debt capital in the firm, see, the attributes are there are obligations which have to be met on debt capital. Periodically, interest has to be paid. It's an obligation. It is not subject to the availability of funds. Plus, at the end of the maturity period, the term period, the total amount of debt capital also has to be paid back. Okay, so by then funds may not be available in the business to pay back the debt capital. Additional funds have to be raised, so that increases the risk of the business. Um, but it is a cheaper form of capital as compared to the equity. See, there is no such obligation to pay a return to the equity holders, and um, we also know that there is no term period. As long as the company exists, the share capital would be there with the company. Individual investors may sell away their shares to some other investors in the stock market, but otherwise they cannot get back the capital from the company. So uh, if we look into from the company's perspective, so having equity capital employed in the business means the risk is low, but the expectation from the shareholders is always high. Satisfying the shareholders is a primary objective of the management. So in that case, to satisfy them, better returns are to be earned. Technically there is no obligation, but dissatisfaction of the shareholders will cost the business, cost the company a lot. Therefore, to fulfill those expectations of the shareholders, the company has to earn better earnings or better returns for the shareholders. So better returns are available, better dividends are paid. So on that note, we see the cost is very high. We see that the risk is high in case of debt capital. So more amount of debt can also very adversely, if it affects to the extent that the company can even go bankrupt. See, non-availability of funds to make the payment, obligations are not met, goodwill gets affected. Many stakeholders may um, in future not come forward to deal with the organization. So gradually it can so happen that it can also be converted into a failure of the business. So the proportion of capital employed in the business, that is the proportion of debt versus the amount of equity invested in the business. More amount of debt, high is the risk. Okay, so considering that, we call that to be as the gearing risk. Risk in the way a business is financed, that is in terms of debt versus equity. Sometimes this is also considered as a part of interest rate risk. Next one is conceptually we need to learn. We don't have to learn in detail about these different types of risks. So technology risk, cyber risk, and environmental risk. Technology risk is the risk that technology changes very frequently. So if they have already invested into technology, because of changes in technology, so whatever they have acquired until then in terms of technology, all that would be outdated. In that case, there is some amount of loss which the business has to bear. So that is called, that is referred to as technology risk. Is the risk that technology changes will occur that either present new opportunities to businesses or on the downside making their existing process obsolete or inefficient. So either it could be upside or downside. It can provide new opportunities. On the same note, it can also affect them on the worst side, that they can be drastically get affected because of changes. Whenever changes take place, whatever is their investment will become obsolete. Okay, investment into assets that they can become obsolete. So it's a loss for the business. Okay, technology risk. Cyber risk is it's a risk of financial loss, disruption, or damage, because external entities or external parties or external intruders enter into the system to cause some damage, destruction to the systems. Any loss that arises on account of these things, we refer them to as cyber risk. So it's a risk of financial loss, disruption, damage to an organization caused by issues with the information technology systems they use. Okay. Um, Most commonly used thing is hackers hacking, entering into the systems as outsiders, intruders entering into the systems. So either to steal the information, damage the information, delete the information, some kind of thing. So that any kind of risk arising on account of these activities, we refer that to be as cyber risk. Then we see the next one is environmental risk. Environmental risk is the risk that arises from changes in the environment, such as climate change or natural disasters. One aspect of it. So that arises from changes in the environment, such as climate change or natural disaster. Then some businesses may perceive this risk to be low, but for others, such, for example, insurance company, the chance of a climate change or a natural disaster happening, the probability of such events are very low. They are not frequently happening events. They are very low. But when they happen, the impact, the consequence of these events is on a very large scale. Okay, the the chance that a loss will happen is very high, and the chance that the event will happen is on the lower side. So when such situations are there, um, One second. The probability that such things would happen are very low. So generally, what do? They go in for covering these things with an insurance. So we also call them as hazard risk. Anything that can be insured, any kind of risk that is insurable, we call them as hazard risk. So some businesses may perceive this risk to be low, but for others, so from the business point of view, the impact is see the probability of happening is low, and at that time there is some impact. So if they cover those events with risk, see, then they are protected against any kind of a loss that happens. On the same note, from the insurance company point of view, see, when a natural calamity happens, then for them, because they have to um, pay the claims, so it would be not on a favorable note for the insurance company. It says, but for others, for example, insurance companies, it can be more significant. Insurance companies have to take environmental risks into account when deciding policy premiums, etc. So, see, if the impact is very high, even if the probability is low, impact is very high, premium amount also will be decided on a higher side. So they would decide higher insurance premium, etc. So anything to do with the environmental aspects, any risk to deal with environmental aspects, we call that to be as environmental risk. I hope it is not boring. I know it would be boring only anybody to go through so many risk at a stretch. Uh, but they are not very difficult because we can understand them by the term itself. So, what are the different types of risk? Fraud risk, because the fraud risk is the vulnerability of an organization to fraud. So, um, because someone is involved in fraudulent behavior, so then any kind of risk that arises, so we can call that to be as fraud risk. Some businesses are more vulnerable than others to fraud, and as a result have to have stronger controls over fraud. Fraud risk is a risk that is considered controllable by most businesses. Okay. Um, See, if there are policies and procedures, if there are effective control system in place, fraudulent behavior can be controlled. See, if there are policies and procedures or guidelines or manuals which are present, employees also would understand what is allowed for them and what is not allowed for them. So, in that case, they act appropriately. Then we also see that sometimes the management is okay with anything that happens within the organization. So they can bear anything. They are not very serious. They do not want these control measures against any fraud to be implemented very seriously. So if the management is not serious about implementing the rules and regulations or the control system effectively, then in that case we cannot expect the employees also to have good conduct. um, I mean, it is not expected of them to have proper behavior, not being involved in fraudulent behavior. Okay, so employee management's seriousness is also one important aspect which has to be taken into consideration. Then the chance that the corporate reputation gets affected is corporate reputation risk. The reputation risk is for many organizations a downside risk. As the better the reputation of the business, the more risk there is of losing that reputation. A good reputation can be very quickly eroded if the companies suffer adverse media comments or are perceived to be untrustworthy. This could arise from environmental performance, social performance, or health and safety performance. So, some information that, see, these products have a negative impact on the health of the consumers, suddenly the reputation gets affected, or they are not following the norms in terms of protecting the environment or something like that, or the way they take care of the external stakeholders, social performance. So these aspects can affect the corporate reputation risk. Employee malfeasance risk. Malfeasance means means doing wrong or committing an offense. Organization might be exposed to risk of actions by employees that result in an offense or crime. We'll do this part of it, risks in international operations, and then take a break. Come back and do what is risk management process. The risk in international operations, um, culture, litigation, credit, items in transit, and financial risk. See, international businesses are subject to all the risk above, but also have to consider extra risk factors, which could be due to the following reason. Because of the cultural differences, if there is any risk that arises. See, a UK business may fail in a venture overseas because it does not adapt to the overseas culture. So, um, inability to adopt the um, other culture of another country, when they are dealing with the trade, they can get affected because of the cultural differences. So UK business may fail in a venture overseas because it does not adapt to the overseas culture. Good knowledge of local culture can, however, give companies an advantage. In the information technology age, having a proper idea and understanding about the culture is not such a big issue. But gone were the days when it was very difficult to know what is the prevalent culture in another country. So knowing that and adapting themselves to those changes was a task then. Gone were the days. But now, I think in this age of information technology, it is very easy to um, acquire the information and understand the cultural differences. Then any kind of a litigation, because they are dealing with international businesses, so that is called as litigation. There is a greater litigation in risk in overseas operations, as the parent company might not understand the legislations well, and therefore they are more at a risk of breaching it. Credit risk, because the see the sales happen overseas. See, the customer, if he does not make the payment promptly, any kind of a risk that arises or loss that arises on account of credit, extending credit to international customers, we refer that to be as credit risk. Chasing debts is more difficult and expensive because of items that are in transit. any kind of loss or damage that arises, there is a greater risk of losses or damage in transit if companies are transporting goods great distances. Financial risks, these include foreign exchange risk, interest rate risk. We will be looking into that section where we will be learning about financial risk and the strategies to deal with financial risk. I know it is boring, or I don't know what was it, but extensively we have looked into different types of risk. So conceptually, if you have the clarity, you can also elaborate, explain that if it is asked in the examination and talk about the different types of risk. See, theoretically, a straight question about what are the different types of risk may not appear, but a situation is given, and then you need to identify what's the type of risk, or some kind of suggestions also can be given. So that would be about what are the types and sources of risk. So after this, let's go for a break for 10 minutes. Like continuously learning so much of theory also would be a little boring. So we will come back and then learn about what is the risk management process that is involved. So we'll quickly run through what is risk management process and what measures are taken to manage this risk. Okay. Then risk response is what we will learn after we come back from the break. So if we can take up a case study in this short time, fine, well and good. Otherwise, we can take up the case study in the next class. Okay. Any doubts in what we have done? Conceptually, very basic ones.
Yeah, no doubts, ma'am.
Okay, we'll go for a break for 10 minutes. Come back at 1:30.
Yeah, okay, ma'am.
So we have understood in the first half of the class, we've understood about what is the meaning of risk, what are the different types of risk. Now that we know there are different risks that business is exposed to, these risks have to be managed. So the next concept in the syllabus talks about what is the risk response system. See, once we know about different types of risk facing the organization, identify their classification, then evaluate the organization's risk appetite. Then we understand about their risk responses. So that is what we will be looking into now. See, what is the appetite? What is their attitude? What is their attitude in terms of the response what they have towards different types of risk? So the risks have to be managed. So any process, the process of understanding and managing the risks that the organization is inevitably subject to in attempting to achieve its corporate objectives. Um, See, if we see that, of course, all of them may not be negatively affecting the business, but yes, there is a possibility of a negative impact also. So if that is the case, the organization has to deal with those situations, those different types of events, and um, the the amount of risk that is present. See, how do they effectively manage this? This risk management process. So as part of that, right now I'm not explaining anything about ERM because after a while we will be looking into what is the ERM. So now let's understand about what's the risk appetite. Risk appetite. See, while setting a business strategy, so when there is a plan decided for the organization, there is a strategy decided at that time. The strategy basically focuses on ultimately achieving the organizational objective. So, the plan that is prepared takes into consideration a very long period of time. So, what is the plan which has to be implemented? That's the strategy that is the planning that is involving a long period of time called as strategic planning or the business strategy. um, when deciding the plan, they also take into account what is the appetite. Now, appetite talks about to what extent they will be able to accept the risk. So the key point here is how much risk the business will accept. Why are we even thinking about that? See, because of risk, the returns would be better. There is a competitive advantage. All that is fine. But if they are hit by that risk, or if they are negatively affected by that risk, there would be um, a great impact on the business. There could be huge amount of monetary losses. Will they able to still survive even if they are hit by a risk? So that talks about their risk appetite. See, some of them may not survive even after a small amount of loss that happens. Some of them, they can still bounce back and then stand up and then continue with their activities. So their appetite has to be taken into consideration, how much risk the business will accept or they will be able to bear it. If everything is fine, see, there is no negative impact, um, definitely they would have a competitive advantage and better returns would be there. But then all the time anticipating only the best possible things to happen is not possible, because there would be fluctuations in a business. So in such situation, if they get affected in a negative manner, can they survive? That is the aspect of what is the risk appetite. So the risk appetite is based on risk attitude. What is their approach towards that attitude? So based on the attitude, we would look into what are the risk responses and what is the capacity, risk capacity. To what maximum extent can they bear the risk? Maximum risk business can accept. So the strategy has to take into consideration what appetite do they have in terms of risk appetite, what is their attitude, and what is the risk capacity. So attitudes, we will talk about it. So then the risk strategy would be framed to manage the risk, to ensure that the risky events that happen in the business, they can be effectively maximized to mitigate the amount of risk or manage the risk. All measures will be taken to minimize the impact it has. In spite of all such measures, also sometimes we still see that some portion of the risk is unaddressed. It still affects the business, and it cannot be minimized or managed. Such a risk is called as residual. Anything which is left over even after effective measures are taken to manage the risk, we call that to be as residual risk. Conceptually learn about that. Now, if you're talking about what are the risk responses, the risk responses, if we talk about, quickly look at what is the risk management um, strategy free features. So when there is a plan which is decided for the future, what attributes would be there? Key features of a risk management strategy are the responsibilities, who would be held accountable after the decisions are taken, so which involves risk. So the responsibilities, what is the attitude towards risk? See, are they embracing, accepting the risk willfully, knowing the consequences, or even before taking up anything, they are very averse towards it. They do not want to invest in any amount into anything which is risky. Okay, what is their attitude? That also matters. See, risk would always be present, more or less, or whatever is that. Some amount of risk would be there in any kind of a decision. So are they avoiding all the time? There is some kind of an aversion towards risk, or all the time they are accepting. So what is the attitude, or they want to balance it? What is their attitude matters. The performance criteria, another attribute when the strategies are decided. see what is the performance which is expected of the organization. So because ultimately all of them have to work towards the achievement of the same organizational goals. So at any level, anybody taking a decision involving risk ultimately has to focus on the overall objectives of the organization, performance criteria, their appetite to take up the risk, their capacity to bear the risk, what are the overall objectives of the organization, the culture that is prevailing in the organization, and the systems um, which are present in the organization. These aspects should be taken into consideration when strategy involving risks are framed. So business strategies, when they are decided, these are all based on first the risky areas are identified, identify risk areas, understand and access scale of risk, development of what is the risk response, what are the risk responses. In the next slide I will take you through that, the risk responses what they have. So right now, so let's just understand that development of risk response strategy. Then a strategy, once it is framed, this has to be implemented. As they are implementing the strategy and allocate responsibilities, whenever anything is implemented, it is closely monitored. Monitored in the sense that the implementation should go according to the strategy that is decided. If it is not implemented accordingly, then there are some deviations. So measures are taken to ensure that the implementation takes place as per the strategy that is decided. So monitoring takes place, and on based on the feedback given upon monitoring, then corrective measures are also taken. So review and refine process and do it again. Then establish risk management goals and set goals, so that ultimately they would be able to well decide on the business strategy that has to be implemented in terms of dealing with the risk or managing the risk, that is risk management cycle. Then the risk management cycle, see, we see that first step is about identifying the risk. What are the areas, risk areas or events which involve risk? Anything like external factors could be there, that is political instability, regulatory changes, um, tastes and preferences of people in the economy, the competitors competition. See, multiple aspects in the external environment. Internally also, the employees, um, their inability or um, do not possess those skills that are required. There are certain weaknesses in terms of their operational activities, maybe some kind of fraudulent behavior. Management is not very serious about achieving the organizational goals. Various aspects could be there internally also. So identify all those areas where or events where risk is present. All of them are recorded in a register called as risk register. There is a register which is kind of a database where all these events are recorded. So in future also, anytime if there is any reference to be made, so they can always refer to the risk register. So there are multiple details about the events, and then as they are all maintained in risk registers. Of late, we also see that there are certain softwares available which provide with this database of what are the possible risky events subject to a particular industry in general, or specific industry, specific business. So we also see that those kind of databases are also available of late. But otherwise, generally, there is a risk register. Risk register has the details of all those events on account of happening of these events. The business is um, faces some monetary loss. So risk record are recorded in risk registers. Variety methods. So there are different methods to deal with these risks are also um, accounted for or mentioned there. Various variety of methods such as brainstorming, internal audit, inspections, external advisors, scenario planning, etc. The first step is to identify what are the risks. And then after identifying the risks are quantified. So identifying the risk or identifying the events on happening of these events, what's the amount of risk, so that's quantified, measured, calculated, assess the amount of risk. So what are the various ways in which the risks are quantified? One is expected value, one is volatility, or we also call it as standard deviation is calculated, or value at risk. We don't have the numerical questions related to that. These are the methods which are used to quantify the amount of risk. Expected value, let's say, if there are multiple variations anticipated, for each variation what's the amount of probability also is anticipated, so multiply the consequence into its respective probability and find out the sum total of that. That is expected value, weighted average. We know what is standard deviation, so calculate standard deviation to measure what's the amount of risk. If there is an average value, anything the chance that the value could be having a deviation from that. Let's say if we talk about a average value, or average value indicates that, let's say, in this population, in this data, if there is an average value, the that indicates that most of the values would lie around this particular value. That is a value which is on an average, or all the other values which lie around this particular value. That is what is the meaning of that average value. Let's say in a class of some 100 students, the average marks in a particular subject is 80. So what does it convey? It is not about that every student scores 80, but most of the values are in and around 80. Okay, so they're closely located around 80, but there is always a possibility that some student might have scored a value as low as 40 also, or somebody must have scored a value as 100 also. So we see that there are values which are located or dispersed far away from the um, central value, from the average value. So in a business also, if we are going with an average value, it doesn't rule out the possibility of a loss happening in the future. There is always a possibility of a loss happening. So what is that chance of a loss happening? Or what is the probability that, or what is the chance that some values would be dispersed far away from the central value? So that is measured by standard deviation. We call it as measures of dispersion. We don't have numerical calculations. These are all theoretically. We just understand what are the different methods that are available to measure the um risk. There is another concept called as value at risk. You might have studied somewhere in financial strategies or something related to. I don't know your paper titles, but I'm assuming that you would have learned about it. But as of now, we don't have the calculations of value at risk at this particular level. I'm not taking anything into detail at this point of time. What is value at risk? The maximum, the worst possible thing, or the maximum amount of loss that can happen at a given period of time, at a given level of confidence. So anticipating a maximum or the worst possible loss that can happen during a given period of time, and that is taken at a given level of significance or a level of confidence. So that would be called as value at risk. So these are different methods that are used to quantify the risk. After that, the risk has to be mapped. There are two variables that are considered, which is, one is what is the impact or consequence, the other one is probability. So let's just look into that part of it. So risk management cycle, what is the risk response strategy and treatment methods? So this is the risk mapping. I have this one presented in the next slide also. Any risk response strategy aims to ensure that exposure to severe risk is minimized, unnecessary risks are avoided, appropriate measures of control are taken, the balance between risk and return is appropriate. So there are two variables that are to be considered. What is the impact of happening of an event, or what is the impact on account of a risky event? Impact or the consequence is the first variable. See, horizontally we see that there is a variable called as impact or consequence. Vertically, the chance or the likelihood, the probability of happening of such an event. Okay, see, the impact or consequence on the left hand side it is low, on the right hand side it is high. The chance of happening, the probability, the chance of happening of an event, see, on the bottom it is low, at the top it is high. So what would be the risk response? Generally, what should be this risk response? This framework is also called as TARA, TARA, TARA framework. We call this as. If the impact is high, but the probability that it would happen very rarely, the chances of happening is on the lower side. But when it happens, the impact is on the higher side. So we see that impact is high, but they rarely happen. Okay, so in that case, the impact can be transferred to someone else. What does it mean by transfer? Transfer is they can cover it with an insurance policy. So if in case if this happens, see, because the chance of happening is on the lower side, but when it happens, the impact is high. So when it happens, instead of they bearing that risk, instead of they accepting that risk, they can transfer it to an external entity. That is to the risk can be transferred to a risk. Uh, sorry, it is to an insurance company. As against that, periodically they would pay a premium amount. So that is the response of transfer. If both of them are low, the happening of it is low. When it happens, the impact is also low. So need not be worried about it. Very rarely they would happen, and when they happen, the impact is also low. So accept it, because not much would be the consequences. So minimum consequence, accept it. See, the probability of happening is on high, but the impact is low. So take measures to reduce the impact, reduce or take all possible measures that they do not happen very frequently. So the strategy is about reduce the probability of happening of the events is high, but when they happen the impact is low. So cut down on the frequency at which they happen, so that is reduce. Both of them are high, very frequently they happen, and when they happen the impact is also high. So the best possible strategy or response what can they have is avoid it. Why accept it? See, if they understand that these events happen very frequently and every time they have a very adverse impact on the business, the impact is or the consequence is very high. So in that case, the response should be of not accepting it, avoiding it. So when can they accept this? When both of them are low. When should they avoid it? Is when both of them are high. See, the probability that the happening is a very low. Examples like natural calamities, etc. See, they don't happen very frequently. They happen very rarely, but the impact is great. The impact is very high. So I think such events can be covered with an insurance coverage. So by covering it with insurance, then they are transferring the amount to the insurance company. There can be a claim against the loss that happened. So they can transfer it to a third party. Okay. Um, then if the chance of happening is very high, but the impact is low, I think a measure should be taken to reduce that. So this is the risk map or risk response. So in connection to this one, let's take up a case study from SPL examination kit. It's based on Tara framework. We'll read through that, a small case study. We'll read through that and answer the questions given in that particular case. This question has using the Tara framework, select and explain the appropriate strategy for managing each risk A, B, C, and D. So we'll take up this particular question. We'll first read through this case study, understand what's given, and then attempt to answer the questions given here. YGT. The board of YGT discussed its need for timely risk information. The consequences of the meeting was that risk consultants should be engaged to review the risks facing the company. One director, Raz Datta, said that she felt that this would be a waste of money as the company needed to concentrate its resources on improving organizational efficiency rather than on gathering risk information. She said that many risks didn't change much and hardly ever materialized, so can mostly be ignored. The rest of the board, however, believed that a number of risks had recently emerged while others had become less important, and so the board wanted a current assessment as it believed previous assessments might now be outdated. The team of risk consultants completed the risk audit. They identified and assessed 6 potential risks A, B, C, D, E, and F. And the following information was discussed when the findings were presented to the YGT board. Risk A was assessed as unlikely and low impact, while risk B was assessed as highly likely to occur and with the high impact. The activities giving rise to both A and B, however, are seen as marginal in that while the activities do have value and are capable of making good returns, neither is strategically vital. Risk C was assessed as low probability but with a high potential impact and also arises from an activity that must not be discontinued, although alternative arrangements for bearing the risks are possible. The activity giving rise to risk C was recently introduced by YGT as a result of a new product launch. Risk D was assessed as highly likely but with a low potential impact and arose as a result of a recent change in legislation. It cannot be insured against nor can it be outsourced. It is strategically important that the company continues to engage in the activity that gives rise to risk D, although not necessarily at the same level as is currently the case. So, in addition, risk E and F were identified. E was an environmental risk, F was classed as a reputation risk. The risk consultant said that risk E and F could be related risks. in the formal feedback to the board of YGT. The consultant said that the company had to develop a culture of risk awareness, and this should permeate all levels of the company. Required criticize Raj that's belief and about the need for risk assessment. Explain why risks are dynamic and therefore need to be assessed regularly. Using the Tara framework, select and explain the appropriate strategy for managing all these risks. She says explain what related risks are and describe how risk E and F might be positively correlated. I'll put this one in a Excel file. So as we look into that, we can also simultaneously write. See here, scrolling up and down may not be. I mean, going through that is not so easy. So I will take this content to Excel file. We'll put this content there. Okay. Now the first question is criticize Raj Datta's belief about the need for risk assessment. Explain why risks are dynamic and therefore need to be assessed regularly. So, if this is the question, I hope you're able to see the Excel file. So,
Yes,
the,
ma'am.
the board of YGT discussed its need for timely risk information. The consensus of the meeting was that risk consultants should be engaged to review the risk facing company. So Raj Datta, the one of the directors, said that she felt that it would be waste of money as the company needed to concentrate its resources on improving organizational efficiency. So she feels that um, there is no need to review the risk. Okay, and rather than on getting risk information. She said that many risks didn't change much and hardly ever materialized, and so can mostly be ignored. So, I earlier from the risk register where all the events would be recorded. So, her observation, based on her observation, she found out that most of the risks, the situation did not change, and therefore most of the risks also I mean the events that happened also they did not change and did not impact the business much. So that is her opinion. The rest of the board, however, believed that a number of risks had recently emerged, while others had become less important, and so the board wanted a current assessment as it believed previous assessment might now be outdated. So there is a difference of opinion. See, one director, Raj Datta, versus the remaining board of directors. So here in this case, she feels that all whatever is available in the risk register is outdated, need not spend time and cost on assessing the risk and the impact on that. So she feels that most of them never happen, and even if they happen, also the impact is very less. But now they identify that new things have emerged, recently emerged, while others have had become less important. The question says, see, the team of consultants completed the risk audit and they have identified that there are six potential risks: A, B, C, D, E, and F. So we also have the details about it. There is a question. So this is a 19 marks case study. SBL does not have a um, set pattern of what would be the marks. See, any case study, depending on the length and the content, they can decide on the number of marks. Here it is 19 marks. The case study is for 19 marks. Likewise, we can see 10 marks, 8 marks, 19 marks, 20, 25, whatnot. See, this particular, only for this exam SPL, we don't see that pre-decided marks allotment is there. So out of 19, out of 19, almost 50% of the marks are allotted. 8 marks are allotted. Roughly about 40% of the marks are allotted to one question. We are asked to criticize Raj Datta's belief and the need for risk assessment. So do you agree that it should be a risk assessment? So um, the question is addressed as criticize. So we're supposed to uh, I mean, we cannot go with the opinion of Raj Datta. We cannot write all what Raj Datta says is correct. The question is directly, question is not asking you to give your opinion, it is asking straight away to criticize Raj Datta's opinion. So you have to take that critical tone. Okay. About the need for risk assessment, explain why risks are dynamic and therefore need to be assessed regularly. So it's an 8 marks, around about 40% of the marks are allotted to this particular question. So what do you think? How do we justify this one about criticizing? We don't have any other option left but to criticize. We have to criticize because the question is asking us to criticize uh, the Raj Datta's opinion, beliefs. Any opinion which you have, any answer which you have? Okay, so criticize her beliefs about the need for risk assessment. So it's in a generic sense. We need to talk about it. After that, explain why risks are dynamic and therefore need to be assessed regularly. That's the second part of it. She is definitely wrong. That's why we are asked to criticize. So let's start with that. What is her opinion? She opines that in the past, most of the risks that are mentioned never materialized. See, if they have not materialized in the past, can we assume that to happen in the future also? No. The reason is from the historical data, from the risk registers that are maintained and available, so she feels that on studying the past information, she said that many risks didn't change much and hardly ever materialized. If they have not materialized in the past, see, future is uncertain. So the past would prevail in the future also. There is no guarantee of that. And in this changing scenario or situation or environment, the history to repeat itself is less likely. We don't see that because the external environment is changing on account of technology drastically. So the scenario that was prevailing in the past most likely will not prevail in the future also. That's one thing. And already the board has expressed, the other board members have expressed that um, the rest of the board, however, believe that a number of risks had recently emerged, which means that the scenario, the situation is changing, it is emerging, new things are emerging. So new risks also have emerged. So constantly now we see that changes are taking place in the external environment. Therefore, expecting what happened in the past to happen in the future would not be appropriate. So we have to criticize Raj Datta's statements stating that the risks that are present, most of them did not have materialize, and the external environment did not change. But the other board members say that new risks have emerged. So when there are new risks that have emerged, so these risks have to be taken into account. She cannot always depend on the risk register. She cannot always talk about the past events which were recorded in the register as possible events that can happen and impact the business. So leave aside those things, the ones which are there in the database or the register. So if they did not happen in the past, we cannot continue with the assumption that it will not happen. Plus, that is a static scenario which is there at that point of time. Now new risks have emerged, so consider those new risks. So criticism will take place about her statement. Divide the statement into two parts: her opinion that risk didn't change much and hardly ever materialized. Both of them contradict, I mean criticize in terms of why would they not happen. Okay, the external environment is changing, that is what is expressed by the board of directors, the rest of the board of directors, that new risks have emerged, therefore they have to be taken into account to understand what's the impact. Then if they have not materialized, see, the past will not continue in the future, it will not prevail in the future, therefore the future has to be assessed according to the changed environment. So criticize her opinion. Okay, so we have some proof also to criticize, we have some justifications, solid information that is available, that new risks have emerged, recently emerged, while others had become less important. So the board wanted a current assessment, so they are right in terms of um, assessing these things again, current assessment. After that, there are 6 different risks that are mentioned, A to B. So let's write what these things are. We have A, then we have B, and F. Okay, what does A say? Risk A was assessed as unlikely and low impact, unlikely and low impact. So if you talk about probability of happening, probability or likeliness, and impact or consequence, if we talk about. So where does A stand? A has um, this is unlikely, and it has low impact. Next, while B was assessed as highly likely. So this is highly likely to occur and with a high impact. The impact here is also high. So I have to write this against B. Next.
Ma'am, in exam, we have to do the table, ma'am, before
No,
saying the
not needed. This is only for ease of understanding.
reference.
It is up to you. The option is up to you. You want to do a table to make it more easy to present or presentable or easy for you to also give a conclusion. You can. Otherwise, you write it in statement format, paragraph for each category. One small paragraph also is fine. Up to you the way you want to do. Okay.
Yeah, okay, ma'am.
Then. The activities giving rise to both A and B, however, are seen as marginal in that while the activities do have value and are capable of making good returns, neither is strategically vital. Coming to C. C was assessed as low probability but with a high potential. High potential impact and also arises from an activity that must not be discontinued, although alternative arrangements for bearing the risks are possible. The activity giving rise to risk C was recently introduced by YGT as a result of new product launch. Risk D was assessed as highly likely but with a low potential. Highly likely, D is highly likely, but the impact is low. And arose as a result of a recent change in legislation. It cannot be insured against nor can it be outsourced. It is strategically important that the company continues to engage in the activity that gives rise to risk D, although not necessarily at the same level as is currently the case. Apart from that, in addition, risk E and F were identified. Risk E was an environmental risk. Risk F was classed as a reputation risk. So the risk consultant said that risk E and F could be related risks. In the formal feedback to the board of YGT, the consultant said that the company had to develop a culture of risk awareness and that this should permeate all levels of the company. What are we supposed to do? So, using the TARA framework, decide what is the risk response strategy. And not only that, we also have to justify our selection, whether it is TARA. Any opinion? What should be the case with A? In Tara, what should be the case with A? I'll put the image once again. Both of them are low, accept. Both of them are high, avoid. Impact is high. Impact is high. Probability is low. Very rarely they happen. So transfer it. Impact is low. Probability is high. Reduce. Take measures to reduce the frequency of happen. And the impact can be further reduced. A falls under which category?
Like low.
Both are low.
Yeah, both are low. Transfer.
Both are low.
Accept.
Accept that. Both are high. Both are high is avoid. Both are low is accept. Both
Okay.
are high because the impact is very high and very frequently, or the chances of happening is also very high. Why bear it? So avoid it. So that should be the strategy. Probability is low. Impact is high.
This is transfer.
That's right.
Next one, avoid. No, reduce.
Reduce. Apart from that, we also have E and G. See here the probability and D and E and F. Sorry. E and F were identified. E was an environmental risk. And F was and risk F was classed as a reputation risk. So there's some explanation given with that. The risk consultant said that risk E and F could be related risk in the formal feedback. In the formal feedback to the board of YGT, the consultant said that the company had to develop a culture of risk awareness, that this should permeate all levels of the company. What should be done with the risk E and risk F? Do they have to take a decision about that? Can they avoid it? Is there a possibility? No.
No.
Can they transfer it? No. Nothing can be done. They just have to accept them. Risk is related to environmental risk. What is an environmental risk? If we look into the explanation of what is environmental risk, that arises from changes in the environment, such as the climate changes or natural disasters. Some businesses may perceive this to be low, but for others, for example, insurance companies, Now this is related to environmental. Now then what can be done in case of environmental risk? Risk F is about reputation. Okay, the reputation is for many organizations a downside risk. As better the reputation of the business, the more risk there is of losing that reputation. Good reputation can be very quickly eroded if companies suffer adverse media comments. So, is there a need for a risk assessment? Like Raj Datta says that there is no need. But when we look into the scenario, the new risks that have emerged, okay, after assessing that, we see that there is a response which is required for many of them. Then assessment of risk is has to be taken up because um, the scenario is not the same like it was in the past. It is changing. That is uh, quite evident. New risks have emerged. Therefore it is important that they have to assess the risk. So maybe even without doing a detailed analysis of the different types of risks, when we just read through that also we understand that um, they have come out with 6 different risks that will have some impact on the business, low or high or something. So these are new risks that have emerged. So it is not advisable to go with the opinion of Raj Datta. So Raj Datta feels that past will prevail in the future, but the situation that is explained in the case study indicates that it is not the same thing. New changes are anticipated to happen, new risks are emerging. Therefore, it is important to uh, take up a risk assessment. Explain why risks are dynamic and therefore need to be assessed regularly. Generic sense also you can talk about it. See, the environment, external environment is ever changing because of so many reasons, because of technology, because of the competitive strategies that are taken up by the competitors, the expectation of the customers. See, there are many changes that are happening. See, what happened in the past, the same thing to happen in the future is not what is the present in external environment. Multiple changes are happening. So when we um, understand, or when we take up the external analysis, the factors that affect the external environment, like we were discussing earlier, pest analysis is one important thing. See, political situations are not stable across the world. Many changes are taking place in every economy. We see political instability, new rules and regulations are coming up very frequently. The tastes and preferences of the people are changing. Technology is changing very importantly. Technology is changing. Okay. Economic factors. See, at a time, multiple economies are going through recession. Inflation is on the rising trend. See, there are multiple changes that are happening in the external environment. Therefore, it is important. We cannot go with the opinion of Raj Datta and say that there is no need. There is a need because of multiple factors changing in the external environment, and um, therefore, risk assessment is important. Please explain that clearly. Briefly, also is fine. But this question is crucial. It has 8 marks given. Don't have to write a very lengthy story. Just briefly talk about it. See, is there a need? Yes, there is a need for risk assessment. Why? Because what is her opinion about the past events, past risks, and the likeliness of happening? See, that can be addressed because the first reason in a generic sense, not no guarantee that past will prevail in the future. Then we can also criticize her on the lines that the other board members have identified, or they have believed that new risks are emerging. See, from the information given in the case study, we can see that they have identified with 6 different risks. Therefore, there are new risks that are emerging. Therefore, a risk assessment is important. it is needed to be taken up. Why is risk assessment dynamic? Because of the external factors, because of the external environment and multiple factors that are changing in the external environment. So we can take the help of pest analysis, external analysis. There are multiple models in APM. We've learned about pest analysis. We've learned about Porter's five forces of competition. So these are all relevant to the external environment, the external factors. So when strategies are to be decided, study about the market, etc. But right now, we are not getting into the commercial aspect, the market aspect of it. We are just looking at the risk aspect of it. So the model which is most appropriate here is pest analysis. So talk about pest analysis, these factors, because of these factors and changes in these factors, it is the assessment of risk has become dynamic. So it is dynamic in nature. Explain that. So 4 marks for the first point, contradicting her opinion, 4 marks, and explaining why it is dynamic. Risk assessment, why is it dynamic? 4 marks. Okay. Don't have to write very lengthy answers. To the point, very briefly, you write also. Each valid point carries marks. How many marks? Depending on the length of the answer, how many points are there depending on that? So 1 mark to 2 marks for each point they carry. Okay. Then, anyway, we've done the 6 different types of risk and the assessment. We need to talk about what is the appropriate strategies from A to D. So, accept, avoid, transfer, and reduce for 4 of them. Justify your selection in each case. So, just talk about that. Justification is nothing but how did you arrive at this answer? Why would you accept it? Because the likeliness is low and the impact is also low. Just explain that. That would be your justification.